Customer activity in sustainable markets is showing good momentum, and this continued into the first month of the new financial year. The business remains highly cash generative, with underlying free cash flow of £50 million, and we're delighted to increase the dividend by 27% to 13 pence. More importantly, we've made some excellent progress in the delivery of the plan we set out originally back in December. Specifically, the regulatory mix is improving, and we're getting paid for the investments being made in product and marketing. We, as you know, have taken out more cost than previously was expected, and we've also done this more quickly than was previously expected. So it's been a transitional year, but I'm confident the business is in a much better place now for long-term growth. I'm going to ask Alex to take you through some of the detailed numbers. He seems to be in good humour this morning, so there'll be a bit of comedy, I'm sure.
Sick, so.
And we'll wrap up then with some more points and questions.
I'm going to try not to repeat everything we've said only a few weeks ago. So there's a lot of slides here, but some of them are, just exactly what you've seen in the past. I guess we'll start out with the P&L for the year. As you guys already know, we've reported 387 million of revenue, 73.3 million of EBITDA. And really everything here, nothing here should be of any surprise in terms of underlying EPS of 31.2 cents a share. I think our depreciation was slightly higher than the consensus, and the tax rate was, I think, 0.4% higher than consensus. So that affected the EPS number. I mean, quite frankly, I focus far less on depreciation, far more on CapEx and the cash. So, I mean, obviously these things could vary a little bit, but I think overall we've said 16% kind of on the average tax rate. This was 16.4% underlying. So I will still talk about 16% going forward, but obviously these things do, change somewhat. In terms of the expenses, and I think if you look at what effectively the administrative expenses, there has been, we have spent a little bit more on marketing, and that's where you see, some of the increase at the end of last year to set ourselves right going forward this year as well. And I can tell you that certainly looking at the May results, we're obviously not going to talk about it, but from the perspective of how we thought we were going to do against plan for May, we are right on track in the first month of the following year, of this new calendar year, fiscal year, sorry. Just a little reconciliation in terms of the reported EBITDA, underlying EBITDA, and then the EPS. I don't propose to go through every one of these changes. I think they're fairly clear. You have them in your pack. Separately disclosed items we've talked about a lot. Obviously the majority of it is the severance and the restructuring costs. There is, just for those of you, just to be clear, 2.7 million of costs of our CDC defense, cost of our bankers, lawyers, accountants. So 22.1 million includes 2.7 million of that. And otherwise, really, fairly nothing new here. On the goodwill, on the impairment charge, 34.6 million of goodwill and 52.1 million of intangibles is how that 80 million breaks down. So yeah, I mean, I think that's really pretty much all on that I'm going to say on here. Everything else, I think is pretty self-explanatory. If you look a little bit at the revenues, and again, this is something we've talked about when we did this presentation before. We've already said that the revenue has been affected by some of the unregulated markets exits, and of course we've talked about Greece, Spain, Germany, and so on. And you could see it here. We have, but if you look at, for instance, the exchange, excuse me, sustainable revenue, which is revenue from the markets we are focused on, increased by about 2%. Other revenues down by about 8%. On sports, sustainable revenue increased by about 89%, and other revenues down by 16%. And on games, sustainable revenue is up 10%. Other revenues down 26%. So the point is that we are continuing to execute on strategy, and I think you'll see this continuing through this year, of focusing our marketing, our investment on sustainable revenue and getting the return from those. Again, as we've said in the past, some of the markets that we thought, the decline in some of the unregulated market was slower than we expected. And we can't predict whether it will continue to be slower, but it has been slower than we expected. We still think it's going to decline, but who knows? We'll see how it goes. But certainly in the beginning of this year, it continues to be slower than we expected. So the next couple of slides, I don't propose to go through again. It's exactly what we've talked about in the past. We've mitigated the regulatory revenue impact. We've mitigated some of the accounting and some of the regulatory EBITDA impact. And the point of these slides is, again, when we look at FY14, our expectation is to continue to work hard to mitigate some of these headwind changes. Now we're planning, obviously the EBITDA expansion is an important point. Obviously revenue growth is an important point. But as I said to some of you already, on the cost side, while the major heavy lifting has been done, we are not going to sleep. We're going to continue to try to look for efficiencies everywhere where we can find them. CapEx, you could see the year, external CapEx, internal development, obviously a lot lower. This is the change in the way we're now capitalizing expenses. Far more rigor is going to be applied. 35 million of CapEx, 5 million of that is Blue Square, 30 million kind of underlying. My expectations, as I think I said a few weeks ago, that we will be somewhere in that neighborhood for FY14 as well. Underlying cash flow, as Brian said, 50 million, clearly cash flow of separately disclosed items. Yes, we're paying some of those. Some of those were paid last year. Some of those will be paid this year. You can see the free cash flow dividends and as Brian already talked about, dividends for this year are going to be slightly better than people have expected. Kabam, others. Again, really nothing new to talk about here. Financial summary. Again, repeating what we've said in the past, but more importantly, I think what we're looking for is we're looking for these trends to continue in FY14. Sustainable revenue up, including UK and Ireland up, and we're expecting to continue to grow that. Again, this is where our investment is going. Cost savings clearly have been achieved, but as I said, while this is a big majority of the cost, I'm sure there's a few other things we can try to do, and we will try to look at those. Free cash flow continues to be strong, 168 million balance, and of course we are debt free. And you can see the dividend up 27% to 13 pence, and in recognition of the fact, slightly more than people expected, in recognition of the fact that we did a little bit better in the year than we were expecting to do. And that's it. So thank you very much.
So again, a slide you've seen before, but just if we can catch breath for a second. We're very happy with the progress we're making. This business feels in very good shape, given what we've done and what we've had to do over the last, I think now 10 months since I got here, 11 months. And we'll talk about that a little bit more in a few minutes. But we've been busy, as you know. The team is largely new. They're working hard, and we continue to make progress on a week-by-week basis. And we've talked about the change in revenue mix. We continue to invest in product. And culturally, I think we've come a long way. Increasingly, we're aware that there's a big price to aim for, and it feels very good. So the exchange, we break out here sustainable geographies, primarily the UK and Ireland, but also Denmark, Malta, Gib, other places where we think we will definitely be in business in, say, 10 years' time, and other are the less ones where there's much less certainty. So revenues in countries that we view as sustainable were up 2% with strong football performance that was offset, as Alex said earlier, by an exceptionally high number of racing abandonments. The withdrawal of the exchange from other countries affected revenues in those markets. The success of operation development, the success of cash out continues. It's now almost 40% of our football customers are using the product. It's available on almost 90% of football markets. We're very happy with how that's going. We introduced cash out on mobile earlier in the year, and we continue to introduce mobile innovations. I think there was a new iPhone app launched earlier this week. with push notifications for score updates and betting prompts. This has helped increase the proportion of customers using the channel, and now almost 60% of UK and Irish customers used mobile in the last year. And we're seeing that the exchange and the sportsbook continue to prove to be complementary. You'll see in a moment that the sportsbook has helped customer acquisition. Encouragingly, many of these customers are moving over to trial the exchange, and a third of new exchange customers are now coming through the sportsbook. Last month, a third of new exchange customers came through the sportsbook. And in sports, revenue was up 33% over the period, largely driven by growth in sustainable markets, primarily the UK, where revenue was up almost 90%. And this was partly driven by the new sportsbook, which was launched in February. And we really only had 3 months of that, 2 and a bit months of that in the full year. And that, as you know, was launched on budget and on time and has continued to improve since launch. I think we've conclusively shown that the Betfair customers wanted a betting product that wasn't necessarily available previously through the exchange. I'm very comfortable with the progress we've made there. And we said that we would differentiate the sports by introducing exchange-based features. And the first of these, Cash Out, for the sportsbook was launched in May. In the coming months, we're already working, and in the coming months you'll see this, to integrate the two products, sports betting and the exchange, so that we can offer exchange-based pricing in certain circumstances to customers who think they're on the sportsbook. We've also launched a standalone sportsbook app, separate to the exchange app, and almost a third of mobile revenue is now generated through that channel. And a key advantage of the sportsbook is that we have a more competitive promotional toolkit than what the exchange alone allowed, and we'll return to that in a minute. So you saw back last month that acquisition and retention have improved. I'll show you another update on that in a moment, but it's worth noting that more than half of the new customer acquisition is now coming through the sportsbook. And as a reminder, we integrated the Blue Square customer base in April with no increase in fixed operational costs. I'm very happy with how that's gone. I would do it again today or tomorrow. And progress has been made. And then, merchandising, we think of this as online retail. A number of you know that that's how I've thought about this for quite a while. And just for a second, highlighting some of the promotional stuff that's now available to our customers that wasn't available to them previously. Tiger Insurance on the Masters, where we guaranteed to pay out in second place if Tiger won. We had a market-leading offer in Cheltenham giving money back on races if your selection finished, giving money back if your selection finished second. We now have a pretty industry common accumulator insurance where you get paid off if one leg lets you down, or refunded if one leg lets you down. And at the bottom right, you'll see a campaign we're running during Wimbledon to push our cash-out multiples on tennis on the sportsbook. So some of this stuff is being offered by our competitors. We're still trialing stuff. I think you'll see that from the range of offers on the site. The way I think about it is that there are fewer and fewer reasons not to bet with us, and we're building towards giving consumers very clear reasons why they should bet more exclusively with Betfair. And the exchange undoubtedly continues with better odds, but we're now being able to offer broader value in a broader sense to different types of customers. And we uniquely will be in a position to offer both. And the sportsbook, as you saw last month, continues to drive customer acquisition. Progress made is clear. We've extended the chart from last month into May of this year. You'll see a 60% increase in the rate of acquisition in the UK and Ireland in May this year versus last year. I'm very happy with that. June is fine. The comp is obviously harder as we had the European Championship last year, but I'm happy with momentum. And the activity level, the UK and Irish actives base, we said last month that we were up 18% year on year for the previous 6 months. Rounding, it's broadly the same level after now 7 months. So the trend has continued into May, and again, very satisfied with that. And gaming's also improving. Gaming was sometimes referred to as the red-headed stepchild at Betfair, and that there was no particular pride in working at gaming here. That has changed. The increased focus on that and a number of new hires from competitors, bwin, 888, and Blue Square is paying dividends. Poker remains tough. We've just completed the migration from on-game to Playtech. That has been tough. But the thesis that customers would come to the sportsbook and have a higher propensity to be cross-sold to gaming seems to be correct. We're improving our understanding of cross-sell. We're filling out product gaps. There still are a few. That includes we're filling out product content for the arcade and mobile apps, and we've recently launched Bingo. So we made a fair amount of progress there and continue to see opportunity. And this is the new slide. The hypothesis here is that the Betfair brand resonates strongly with the UK customers and more broadly, and that the product offer wasn't broad enough to satisfy their appetite. And this is a way of showing that we're actually getting customers to engage with more products, so not purely exchange alone. One product would obviously be one. This would cap at 3 if they're engaging on sportsbook, exchange, and gaming, and the trend is encouraging. You'll see that the metrics were previously reasonably flat. With a bit more focus and stretching the brand a bit, we're seeing a bit of trend there, and we hope this is helpful to people think about what we're trying to do to utilize the brand better in a broader way than previously. And mobile is good. I think we continue to not tell the mobile story quite as well as we might. I'm happy to return to that in Q&A, but there are some specifics about the mobile, about our customer base, and also how we report revenue that makes me think that we're probably telling that story less aggressively than we might. But we're making good progress. There's been a number of product enhancements, and we have a strong pipeline of stuff that we continue to want to build, and we see strong growth. Revenue doubled in the year following a 48% growth in the number of customers and a 40% increase in mobile ARPU. This channel is increasingly important for customer acquisition. More customers join via mobile than on the website in recent months. And Betfair US, trading as TVG. We flagged in May this business achieved profitable EBITDA for the first time in a long number of years. This was as a result of cost discipline and some operating leverage. We said then, and I absolutely believe now, that margins can continue to improve in this business. It can be run more efficiently, and I would expect revenue growth to continue, if not to accelerate. We continue to be in discussions, positive discussions, about the opportunity to offer exchange wagering in the United States, in New Jersey and California. And of course, online gaming legislation is about to happen, has happened in Nevada, looks like it's about to happen in New Jersey. Uniquely, or almost uniquely, we own one of the few legal online wagering businesses in the United States, and we believe there's optionality in that when the market opens up. And as I said last month, I continue to expect the US to be a growing proportion of Betfair's profits in the year to come. And then outlook slide. We are very much where we were a month ago, but we believe the strategy will lead to an acceleration of revenue growth, and we forecast that we will be able to get UK revenues to grow in line with the market in the medium term. In markets where there's insufficient regulatory visibility, revenues continue to be expected to decline in the near term. We were upfront about this back in December. It's hard to focus how fast. It's true, as Alex said, it has declined less quickly than we expected, but you know, it's in the press this week that a number of operators have switched off in Bulgaria, and not just will revenues decline because we're no longer aggressively marketing in those countries, or actually marketing in those countries, we also expect revenues to decline because in places like Bulgaria, where there's a 15% turnover tax, we'll actually go out of our way to block all play. In the longer term, we continue to see Italy and Spain as potentially attractive sources for growth following positive regulatory developments. We talked about how we expected to see Italy live at the end of this financial year, beginning of the next year, and I think we're still okay with that. We're working towards that. And our balance sheet remains very strong. We've talked about how we would increase our domestic scale, and when I say domestic, I don't just mean in the UK, but to bulk up our scale in markets where we're present. We have appetite to achieve geographical expansion, and there's also a need, there's an imperative to close product and capability gaps where that can create value. We will only do this in a disciplined way, and it may be that opportunities do not arise. We will be targeting returns from any acquisition to be significantly above the cost of capital. We said last month that we expected to show demonstrable progress of that over the next 12 months. A month has passed. I now feel that I have 11 months to show demonstrable progress. But we remain focused on using all of the assets, including the balance sheet, to create value for shareholders. We continue to focus on efforts to mitigate the expected introduction of the point of consumption tax in the UK, and we continue to believe that increasing our scale will aid margin expansion. So then finally, in summary, it's been a transformative few months. It's been a transformative year for me, but it's been a transformative few months for Betfair as well. It's largely a new team. They're very focused. I'm very proud of the progress they've made. We absolutely acknowledge there's still a lot to do, but we greatly look forward to the challenge. And, you know, some days now it begins to feel, or it feels like we're beginning to start winning. To conclude, as you know, we delivered a stronger outturn than expected to the year. Across most dimensions, I think we've made good progress, and we have a growing ability to tackle the opportunities for future growth. As a team, we're excited about growing this unique business and optimistic about the year ahead. And with that, I'm happy to take questions. Just for the call, we just ask you to introduce yourselves and use the mic, please.
Good morning. It's Josh Littman from Citi. Can you give us a bit of colour on the trials you're currently doing for changing the pricing, and when you might expect to roll something out larger scale?
Yeah, so I think, Josh, if we go back to where we were in May, we talked about how this is potentially a very important lever for value creation. We therefore will do it in a careful, prudent, sensible way. That will take some time. We talked in May about how we were trialling in 5 markets where we had trialed both price increases and decreases. I think we're now up to about 24, and in addition to changing pricing, we've now also made changes to the discount ladder, so the rebate curve where customers get rebated for their volume. There really is no substitute for just seeing how it goes. There really is no substitute for time. I reminded someone last night, there's a book on software development called The Mythical Man Month, and no matter how hard they try, 9 women can't have a baby in 1 month. So we have to let this play out. We will report on it as soon as we have information to report, but we're learning as we go, and we appreciate that this could be quite a lever for value creation. Sorry, there's someone behind you.
Hi, it's James Hollins from Investec. I've got 3, if I may. The first one's on, you say UK market growth you expect to be in line. Just give me a feel for what you expect UK market growth to be and why you wouldn't be higher given you've only really just launched such a core product for the sportsbook. The second one is on, if we look to full year 15 cost savings, I think you're talking about annualised or full year 30 million in 14. I get the feeling there's more to come, so maybe should that sort of 30 to go up to 40 or 50 in full year 15. And the third one is, there's a clear indication you're not returning cash, you're giving yourself time to look at products and investment. Maybe give a feel for where you think there are product gaps you'd like to fill by M&A and where geographically. Thanks.
I'll try and take those. UK market growth. So to be clear, in the medium term, and that's not this financial year, but in the medium term, I think we can grow UK revenues in line with market growth. UK market growth, depending on who you ask, is high single digits, something like that. You're right, I think we can grow the sportsbook faster, but obviously we have a very mature exchange business, which I don't think we can expect to grow at that rate. And we, despite some parts of our business coming from a smaller base, we're competing against very well-run, larger competitors, so it's by no means trivial. But I think, if we can get the overall UK revenue, I think we should demand faster UK revenue growth than we have seen in recent years. About the cost thing, Alex is speaking to the internal audience as much as the external audience when he reminds people that he's not asleep. We talked back about the aspiration to take out 20 million. We were able to take out 30 more quickly than we expected. We're not targeting another fixed cost bucket like that. We are instilling cost discipline and efficiency across the entire business. We said last month, and we reiterated today, we're now very focused on revenue growth, but running the business more efficiently as a cultural thing as opposed to anything else. About the cash, as I said, the balance sheet is an asset, and I think it's our job to use the assets to create shareholder value. To illustrate product gaps, conceivably, I'm sure I'll get investment bankers excited now, but conceivably there might be gaming businesses in parts of the world where we would be able to get some technology, some customers, some profits that would be completely incremental, and some capability that would be completely incremental to the group. I think also, though, as we said, there are the opportunities to add on more scale, be that small things like Blue Square in the UK or bigger things elsewhere. I don't think we're helping shareholders by being much more prescriptive than that at this stage. Sorry, Yvonne, I'll come to you in a sec. Ivor.
Thank you. Ivor Jones from Numis. Can I follow on from James's question on where revenue's going in the UK? You've given us a couple of data points last time and now about a strong increase in actives and an enormous increase in new sign-ups, and yet you're talking about relatively modest growth. Shall I assume that's because the new sign-ups, with the new sign-ups, you're experiencing relatively low ARPU from those sign-ups, and that's how I get to low revenue growth? Or is it because you are assuming that the growth rate drops off dramatically as we go through the rest of the year?
Yeah, so I think there's a few things. I mean, there's a lot of moving parts in the business right now. Actives are strong. We still have product gaps. You know, we rolled out new rugby last week, but you know, we still don't have as good a rugby offer as many others do. And at the start of a Lions series, you'd like to be further ahead. We're launching an improved offer in 3 new sports this week. And there's more sports to come over each of the next following 4 weeks. So we still have work to do. And I think the phrase I used back in May is that we're making the brand more relevant to the UK consumer than it has been in a while. But by no means do I think we have the product in place yet where we're definitively winning. So we make the brand more relevant. We re-establish our right to take share of wallet. But you know, I think we have a fair amount of work to do to refine the product, to refine our processes, because you know we've only been in the fixed odds business for a short period of time, and to refine our marketing. Therefore, I think we aspire to participating at the market growth rate, but we're not there just yet.
I don't think that's quite the answer, because what I'm trying to get at is if you had shown the early indications of ARPU from the new sign-ups, would that now be leading us to much higher revenue?
No,
but you're being cautious and assuming that the number of sign-ups declines through the rest
no,
of the year.
so I think we chatted, maybe not with you personally, but I think we chatted about this last month. It's a very dangerous time of the year to extrapolate, right? We definitely talked about how March and April, where a lot of the sign-ups came, plus there was some of the sign-ups came through Blue Square, that given Cheltenham and given the National, it's a dangerous time of the year to extrapolate too aggressively from. Additionally, given, and we said this back last month, given the increase in mobile and given the pretty well understood, given the increase in mobile and given the fact that mobile may or may not have different propensity to bet than web, and given that we're taking the brand to a more recreational customer base, I'm just wary of letting people extrapolate too quickly from that. So I'm asking for some time. We'll bed it down. Undoubtedly, some of our marketing, though well-intended, has been less efficient than I would like. In other places, I think we've got very good value for money. Delighted with the Blue Square deal. It's just too early to really extrapolate too much.
Well, thank you. And can I continue with marketing and
Please.
also what you were talking to James about in relation to capital? What you haven't said you could do with the capital is massively increase the amount you spend in the UK. Clearly, you have the firepower to distort the market and appear everywhere.
Yeah.
Might you, if you figure out how to do it, or is that out of the question? Is that one possible application of capital?
I think what we said, we talked in May about how we had taken out 30 million in cost savings, and we were going to put 10 million of that back into product and marketing, product and brand. I think we will continue to invest where we feel we get a return on that. I think we're not saying that we intend to distort the market, to use your words, in terms of ramping marketing spend in any game-changing way. I think we don't have the business is not ready for that, even if that was the right thing to do in terms of capability. Plus, the market's pretty dynamic, and it's interesting to watch how some of our competitors are trading in the expectation of the tax arriving next year. So we're watching this. It is moving around pretty quickly. I'm happy the business is getting better. And you're right, we have the resources, we have the wherewithal to compete on a number of fronts, but I'm just not able to give you guidance on that just yet.
If I may just add, now, you know, if you look, as Brian talked about Italy, right? So if you take that as an example, and if you look at the example when we were ready to launch the exchange in Italy, which I think we said was going to be by the end of this year, right? Obviously, there's going to be a significant marketing investment supporting that. We'll highlight it when we're there. So there is some, you know, there's those kinds of opportunities which we'll probably have to take advantage of. Yeah.
In absolute spend-wise, in absolute marketing spend, we're spending a fair chunk in the UK. I think it's important that we actually spend that more efficiently first and actually understand the best way to position our brand before we start spending it. Before we start spending more. That's a work in progress.
Thank you. And you've talked a lot about new stuff. Going back to old stuff, we're trying to understand the dynamics with in the exchange. In the past, Betfair's talked about revenue from the API, particularly, that's shown there's quite a concentration, obviously, in core customers. How healthy is that bit of the exchange? What's the mix between big commission generators, small commission generators?
So I don't think we've talked about that since I came here.
You haven't.
Okay. I think the exchange is healthy. We have talked publicly and with our customers about the intention to put the sportsbook and the exchange together. I think it's probably fair to say that the sportsbook type business can be seen as more recreational and probably more likely to lose, and that will feed into the exchange in a way that should be synergistic. That in turn makes the exchange more liquid. The whole thing, there should be a healthy, the whole thing should be synergistic. But we're very happy with the state of the underlying business.
Okay. And last one, how did costs for the non-bid get to 2.7 million? And are you accounting for all of them in 13, or is there more to go in 14?
There's nothing more. That's it.
So I thought you had said not very much when it came to costs a month ago.
No, I didn't say not very much.
No,
I
your
think
chairman did.
well,
Our chairman is rich.
sorry, if you ask our advisors, they would say the costs weren't very much, but yeah, it's all
Will
done.
spent 16 million on the sporting bet, and that was a pro rata. That seems like a significantly better value. I just wonder how it could get to so much for relatively little.
You have to ask the
Well, you come from a house, Ivor, that knows all about fees, so you should be able to get there quite quickly, and you'll see that Alex has already given the advisors the hairdryer treatment, and given the intensity of the workload over that period, it was very good value.
Right. I think Numis is known for very good value, actually. Very good. Thank you very much.
Vaughan.
Vaughan Lewis from Morgan Stanley. Just coming back to Blue Square, did you say the new Blue Square customers were in new activations for the UK? So on that chart, how much of that is Blue Square then?
Yeah, I'll take that offline because I have the number at the top of my head, but it's in
Okay.
the chart. We gave the number out in May. We gave some clarity on what that was back in May. I'll just take it offline if you don't mind.
Sure. And then since they've come online, then what sort of level of attrition have you seen? Because that was about 15, 16 million of revenue in Blue Square, and you're saying you haven't got any costs on that. So that could be transformational for your profits.
It wasn't as high as that. There was some of that was other rank businesses that weren't Blue Square businesses when you think of their total revenue number. So I'm very happy with that. We get a return on it. But I don't think we're not going to give numbers in terms of, we're definitely not going to give numbers at this stage in terms of what kind of return.
Okay. But it should be a significant boost to profit this year, presumably.
Well, we did it because we thought it was the right thing to do, and I'm pretty happy that, as I said, we do it again tomorrow.
Okay. On
But your base number is too high.
Okay. On the split between the other international businesses, the non-sustainable ones, is about 24, 25 million per quarter at the moment. Can you give us any more sort of breakdown on that and how to think about that? Is there anything left in there for Greece, Germany, Cyprus? How does it break down between the ones that are sort of higher quality that you used to call it, Sweden, Spain, things like that, and the other stuff that you're expecting to wind down?
We won't break it down. I think through the end of the year, I think we're pretty much done with Greece, Cyprus, and Germany in terms of the major declines. But there's many countries in there. Some of them are slightly up, some of them are slightly down. So it's just impossible to say. Some of them are doing better, some of them, but we won't be disclosing Sweden or Russia or anything specifically like that.
It's less lumpy than it was. We're not aware of any reason why it will become, the decline rate will accelerate much. That being said, you get places like Bulgaria where we switch it off completely. So, but it's less lumpy than it was.
That 100 million a year roughly then should be fairly stable.
Well, I think it'll continue to decline, both because we will continue to not advertise and because I think we will actually switch off some places over time.
All we talk about is the rate of decline is less than we expected, but it's still, we would expect it to decline.
Okay. And then just coming back to the cash pile and the deals, are you looking at big deals then where you could invest, the majority of that cash, or are you talking about more sort of bolt-on deals like Blue Square? And if so, will there be a joining sort of cash return policy? Because the dividend's up a lot, but it still looks very stingy relative to cash flow and relative to the balance sheet.
Well, look, Vaughan, there's a lot of things going on here. The business mix is changing. The competitive landscape is changing. The taxation base is changing, or will probably change next year. As I said earlier, the balance sheet is an asset. We should use the assets to create value if we can. Opportunistically, if something comes along like a Blue Square, obviously we'll look at it very hard. And if there are bigger opportunities that have the opportunity to create real shareholder value, we will look at those very hard as well. I don't think it's helpful to be in much more detail than that at this stage.
And you wouldn't rule out using paper for a larger deal, presumably?
I mean, we will take advice and we will make the best decision we can at any point in time. But we're in the speculation arena right now, and I just don't think that's
okay. Thank you.
Hugely helpful.
Morning, it's Chris Stevens from Barclays. Just 2 questions from me, please. You mentioned you think the sportsbook will grow quicker than the UK market. The exchange, more mature product, will grow slower. Do you have an optimal level in mind for the contribution from each going forward, in terms of how much each of those contributing to revenue? And the second question is, I appreciate it might be too early to say, but after the introduction of GPT, do you see the market cutting back on marketing spend? Clearly, everyone's been spending a lot on marketing spend, and do you think that might be one way of mitigating this extra cost?
So let me take the revenue mix question. I think in a number of years' time, people will talk less about the product labels of sportsbook and exchange. I think people will talk about Betfair's UK revenues. Sorry, they might talk about gaming and sports. We will take profitable revenues where we can get them, provided we believe they're coming from sustainable jurisdictions. We're very focused on growth. I'm happy to take it in the exchange or in the sportsbook or gaming. And in terms of an optimal mix, we absolutely believe that the exchange is fundamental to our brand positioning and to our right to grow, and therefore we will be very careful not to underplay the importance of the exchange and to mess around with the ecosystem of the exchange. But if it comes, most of the growth comes from sport, so be it. We'll find a way to make that work. About the point of consumption tax, it's a really interesting time, right? You have some people that seem to be ramping marketing spend in advance of the expectation of trading with tighter operating margins next year or towards the end of next year. You have other people who seem to be running their businesses much more leanly with the expectation that they have to make operating margin, that they have to pay tax next year. We just have to play it out and see. I don't know that the absolute marketing spend will fall of the big guys. It might, but it might not. It's just too early for us to forecast that. But when you have conversations with people, I think a lot of them are, we're all very focused on it and all very focused on the transition to a post-tax environment. But as you know, some of our competitors still think this won't happen. So it's an interesting time. It's very hard to extrapolate with certainty.
Hi, Richard Stuber from Nomura. Just 3 questions, please. In terms of the price trialing, as well as doing the basic commissions and the rebates, obviously, are you also looking at premium pricing? And if you did, and is there premium pricing outside your sort of core UK market? And I suppose together with that, any sort of indication of how much of your UK revenues are based upon the premium pricing part, as in with your big main 500 customers, how much they contribute to the main UK pool? The second thing is, I know in the past, you've broken down games in terms of poker and casino. Is there any sort of colour in terms of poker being a casino, which ones are doing well, which ones aren't doing so well? And finally, in Australia, I know your profits were offset by the increase in race field fees. Do you see anything offsetting that going forward, or do you see revenues growing along sort of high single digits, similar to what you saw this year? Thank you.
They're all great questions. I'm not sure I'm going to be able to be very helpful. I mean, premium charge is obviously part of the pricing mechanic. We haven't talked since I joined about any great split in terms of how that's what proportion of revenues that forms. We are doing the two things you've talked about, and premium charge is on the list. I'd be delighted if we got to a place where we could change that to lower that in some way, or change the mechanics so that it wasn't that it didn't upset customers in the way it seems to do so. But we've no plans to announce at this stage. The gaming mix is pretty much as you'd expect. Poker is very tough. It's a tough market, and we had a migration on top of that. So that's pretty. It's a very tough place to be. At the gaming side, the rest of it, the arcade and the arcade and casino, is performing better. We've just launched bingo, but it's in the last number of weeks, so it's too early to say. Plus, it's probably the furthest stretch from our brand. Although our bingo team tell us that the cross-sell is interesting. In Australia, I don't think we fully lapped the 1-year introduction of the price changes. There's some encouraging news in Australia about product fees, but the regulatory. There's some encouraging news, but equally there's, if your glass was half empty, there's also some adverse news in that the regulatory stuff isn't playing out particularly well, and there's still saber rattling about how product fees should go up or how product fees at certain times of the year should go up. We mitigated some of that. We obviously introduced the price changes as well, the commission change, which has helped, but it's a small business that's subscale in a tough market against some very well-run competitors. So. We're obviously focused on it, but I think there are other parts of the business that are getting more of our time, specifically competing here closer to home.
Okay. So can I just follow up on the last question? Does that mean you think that is Crown playing a larger part, or do you think they would be interested in buying the other part of you, or is it now non-core basically?
No, I'm not saying it's not core. I think it's a fascinating market, but there's only so many hours in the day, and we have an opportunity here to run this business better day by day, literally on a week-by-week basis. I feel like we're making progress here in the UK. We make progress in Australia as well because they leverage some of the technology. They benefit from our liquidity as well. But I'm just day to day, the progress being made here is more tangible. At Crown, you'll have to ask them about their views. They seem to be busy. They've got a few things on themselves with land-based casinos and whatnot. The business is fine, but I don't think it's as defining to the future of Australia or to Betfair as the progress we make in the sustainable markets closer to home. Is there anything on the phones? Fine. I think just if I go back to Vaughan's point, we paid a 4 pence dividend back in December. Gerald talked about how we were going to a more progressive and sustainable rate that would typically imply 12 pence for the year. We're happy to, EPS improved, revenue was better than expected, EBITDA was better than expected, so we paid a slightly higher dividend. It's our intention to continue in that vein. Thank you all for making the trek to Hammersmith again. It's good to see you. We'll be around, happy to take questions. But in summary, thanks for listening. I'm sorry there wasn't more news here, but you heard a pretty good version of it last month, and we're happy with how things are going. Thank you all.